The U.S. retirement savings crisis is not on the horizon. It's already here, and the middle class is going to be decimated by it. The erosion of incomes in America is ultimately going to deteriorate the quality of life of millions of middle-class workers when they reach retirement age. And according to a new study, almost half of them are at risk of falling into or below the poverty line. Over the course of many decades, middle-class Americans have been induced to believe that our current retirement system can provide the security and stability they need when they reach their golden years. But that can't be farther from the truth. In today's video, we did the math and brought the cold, hard numbers that prove that for the vast majority of us, it will be impossible to maintain our living standards as we age. Before moving on, we kindly ask you to support our work with a thumbs up. And please don't forget to subscribe. At this point, you probably already heard that the United States is facing a retirement crisis. Millions of Americans simply don't have the means to save enough money to provide for themselves when they get older. Before, this was mainly true for low-income families. But now, with the rampant cost of living, stubborn inflation, and soaring interest rates, the share of middle-income earners who are overwhelmed by rising debt and in living expenses and can't save money for retirement is just daunting. Just like food and housing, retirement is a necessity. Eventually, we're all going to get to the point where we can't work anymore, and society tells us it is our duty to make arrangements for when that happens, because at some point we will no longer be able to earn an income. However, the cost of retirement has risen exponentially. Italy and middle-class Americans are going to be disproportionately impacted by this looming crisis. A new report released by Economic Policy Research found that the percentage of pay middle-income owners have to save to finance an adequate retirement has ballooned over the past 2 decades. In the year 2000, a retiring middle-class wage earner would have had to have saved over their career 5% of their monthly pay to finance an 80% pay replacement in retirement. In contrast, a middle-class wage earner retiring in 2022 who would have had to save 15% to 20% of their pay when adjusting to today's inflation. Today's wages and residency area, that is a 300% to 400% increase in the cost of retirement for this worker, which would require an additional 10 to 15% share of their salaries to be saved for retirement year in and year out over a 40-year career. Research shows that amongst the middle-class workers who are saving for retirement, those who are putting 15% of their income aside are the exception to the rule only. 31% of middle-income Americans are reportedly saving money for their future. Of those, only 9% of middle-income workers save 15% or more of their income for retirement, according to Pew Research Center data. At the same time, 42% are not currently saving for retirement, and from those, 53% are baby boomers reaching retirement age. Meanwhile, 27% of middle-class workers have empty nest eggs. No wonder why a quarter of them expect to never retire, according to the Kuna Mutual Group 2022 middle-class survey. Of those who are saving for retirement right now, 7 in 10 wish they were saving more, and they cite the rise in the cost of living as the top reason why they can't put more money aside. Social expenses come in second place, and credit card debt is a close third. The analysis of the survey results also highlights that 54% of middle-income baby boomers still in the workforce have less than $25,000 saved for the whole of their retirement, with 49% of them set to face their golden years with less than $10,000 saved. And even though they're within a few years of reaching traditional retirement age, only 47% of middle-class baby boomers who are still working are trying to build up their retirement funds, but just 16% are saving 15% or more of their income for retirement. Approximately 3 in 10 are putting away less than 10%. Even more alarming, more than half of working baby boomers who are not currently building up their retirement funds report having no plans to save for retirement in the future. That is extremely concerning, especially considering that roughly 10,000 middle-income baby boomers reach age 65, the traditional retirement age, every day, according to Pew Research estimates, which means that at some point in the near future, the retirement savings crisis will turn into a massive snowball that will run all over us, and we as a society will be forced to deal with an oppressive number of people that will not be able to work or to provide for themselves. This puts pressure on the public for financial support, ultimately affecting all American taxpayers today. One of the reasons that lead many Americans not to consistently save for retirement is their belief that Social Security benefits will replace a significant portion of their income. But that isn't necessarily true for middle-income owners. Social Security is supposed to serve as a floor to prevent extreme poverty in retirement, but it's not supposed to replace the full amount needed for a dignified retirement. Social Security only replaces approximately 40% of of income for low-income owners, but for the middle class, that number falls to 30%, and that replacement ratio is steadily declining. Given that the program is underfunded by around $7 trillion, the middle class is left behind by the retirement savings system in key ways, reports NERV's research manager Tyler Bond and Dan Jr., the executive director. Social Security replacement rates are too low for middle-class families to maintain their standard of living in retirement, but many middle-class households don't reach the level of income and savings needed to truly benefit from the tax incentives for individual savings. This means the middle class too often is missing out in terms of benefiting from various retirement savings programs, the experts explain. In other words, Social Security is specific, designed to help the lowest earners, while a tax break system is designed to help the highest earners. Guess which group is missing from that equation somewhere? Workers still have some type of retirement plan provided by their employer. In earlier generations, this plan was usually a defined benefit pension. In fact, in 1983, 62% of workers who had a retirement plan through their employer had a pension. Now that number is a mere 17%. Instead, today, most private sector workers have a defined contract 401 Kelvin plan, and the stock market swings faced in 2022 have proven how risky those plans really are. In the past 12 months, over $3.1 trillion have been wiped out from 401 Kelvin plans, affecting 46 million accounts whose balances fell by an average of 25%. Rising interest rates also play a part in that narrative. When interest rates are low, the value of income in the future goes up, and that goes for interest on bonds and earnings on equities. The performance of the capital markets is also a function of interest rates. Simply put, when interest rates go down, bond values go up and vice versa. So the combination of lower interest rates plus lower capital market returns results in a net increase in the value of retirement income. But when interest rates rise and capital market returns follow suit, the result is a net reduction in the cost of retirement income. In other words, the Federal Reserve's interest rate hikes are making it harder to save for retirement. On the other hand, the reality of inflation and the recession threat are also weighing on middle-class households. A CNBC survey revealed that 75% of middle-class Americans say their earnings are falling behind the cost of living. Moreover, there's also been a general increase in financial worries in the last 6 months, with 40% of those surveyed expecting to be worse off financially in 2023. It's up from 28% in January 2021 and 17% in January 2020. It's now 40%. There's a higher level of concern financially among middle-income families than there was even at the height of the pandemic, stressed Glenn Williams, CEO of Prime America. When you see rising prices and staples like gas, rent, things you can't avoid, it comes down to tougher decisions around priorities. Williams added, inflation has generally wiped out the boost in income seen over the past decade and in many cases actually resulted in a pay cut. With all things considered, it's evident why the middle class is struggling to accumulate sufficient financial assets during their working years, Williams noted. Tyler Bond, manager of research at the National Institute on Retirement Security. Against this background, a recent study by the Schwartz Center for Economic Policy Analysis at the New School has uncovered that nearly half of middle-class Americans will face a slide into poverty as they enter their retirement. The paper exposed that roughly 40% of Americans who are considered middle class will fall into poverty by the time they reach age 65, while an additional 8% are likely to fall below the poverty line. Additionally, the Economic Policy Research projects that the number of 65-year-olds who are poor or nearly poor has increased by 146% between 2013 and 2022. In 2012, there were over 644,792 poor or nearly poor 65-year-olds in the United States. However, each year from 2013 to 2020 to 22, there was an average of 1,586,335 falling into poverty, which results in 15,868,330 Americans facing poverty at retirement ages. Researchers wrote to illustrate how many people we're talking about. The total number of poor retirees is enough to fill over 319 Yankees stadiums. This also means that seniors' assets, including their savings for retirement, their homes, any other investments they own, as well as Social Security, will not be enough to keep them above the U.S. poverty level of $11,011 per year. Overall, 45% of all baby boomers are projected to be poor or near poor, meaning they have to live on $16,517 or less. The research concluded, life at the federal poverty threshold looks terrifying, especially for those who have had the opportunity to live a comfortable life. Using the latest data from the Consumer Expenditure Survey, the researchers found that an elderly person living at 100% of the federal poverty level would have less than $9 per day for food, $680 per month for housing, just over $8 a day for transportation, around $180 a month for utilities, and approximately $144 a month for healthcare. Over the past 5 decades, the number of middle-class households fell from 662% in 1972 to 49% in 2022. That is to say, not only is the middle class shrinking, but the number of middle-class Americans falling into poverty is rising. And when a tidal wave of retirees face the stark reality of not having sufficient means to afford their lifestyles, this situation is only going to get worse. Our society makes us believe that only through financial discipline and individual effort will we be able to enjoy our senior years without major concerns. Every now and then, some peculiar financial experts make the headlines by selling the perfect formula that will help you accumulate millions of dollars by the time you're 65. It goes without saying that that is total and complete BS. For example, this new study published in the Financial Analyst Journal says retirement is not hopeless, and then it proceeds to tell middle-class Americans that all you need to do is save 22 times the annual income you have by the time when you retire. So let's say you make $150,000 and hope to retire on $100,000 a year, which means you'll have to put away $2.2 million in a bank account to be able to retire comfortably. That also means that the authors of this study assume you will live to be 100 to 150 years old, a very improbable life expectancy for 99.996% of the world's population. Then big outlets like the Wall Street Journal briefly call this arrangement retiring on your own terms, as brilliantly explained by Heidi Moore in an OPA said for The Guardian. You can call it retiring on your own terms the same way you can call buying a private jet and or Arching Colorado living on your own terms the terms that is a fantasy and not reality. Moore emphasizes it's simply a math problem. Let's say you're in your 40 making $150,000 a year, a generous salary in almost any city in the country. But after taxes, that dazzling sum drops to $100,000 a year. At the same time, if you have that money, you also have to live on it. So how can you save 22 times that amount by the time you retire? One standard solution given by LearnVest is to use a simple formula known as 50-30-20, in which you spend 50% of your salary on essential expenses. Another 30% goes to lifestyle expenses, things that make life livable, Moore says. And the final 20% goes to saving for retirement, but with explosive costs for nearly everything in modern life. That ratio doesn't seem to work anymore. In your 40 seconds, if you reach that pinnacle of saving virtue, it would take 110 years for you to reach that goal. Yeah, if you save $20,000 a year, you can expect to collect your $2.2 million in some future utopia. Moore highlights, adding that if you save 30% of your salary or 30% a year, it'll take you 73 years to get the $2.2 million. Saving for 73 years is ambitious if most charts tell you you're lucky to live for another 40 minutes 50 years after your prime working years. There are also a lot of impossible assumptions in plans like these. An obvious one is that even if you reach $150,000 a year in annual salary, you'd have to make that same amount and make it nearly forever, never suffering a layoff, never taking a pay cut, and that is a far-fetched expectation. High salaries, as a rule, don't last forever, the analyst outlines. This is why the cult of saving for retirement needs to be held in checklist to brainwash anyone and pile guilt on hardworking families for having some mild enjoyment of life rather than living only for the future, Moore says. In effect, the retirement crisis in America is less due to personal failure than structural failures, the analyst describes. At the end of the day, savings are not the root of the problem with our retirement system. The main problem is that our wages have been steadily dropping for decades. Corporations have been largely hoarding profits, giving CEOs generous bonuses and barely readjusting what they pay to their employees so that their salaries can keep pace with inflation, while corporate executives have seen their pay skyrocket by 876%. In the past 40 years, our salaries have increased by just 41% over that same span. Government policies and the underfunding of Social Security are a clear demonstration that authorities are not taking care of people's interests. Instead, they're making life harder for many of us. The mere mention of the idea that corporations should be held responsible for the impact they have on the lives of the 99% can make the elites hysterically complain that this is an attack on wealth creators. But what does that make the rest of us? If only we could impose the same kind of financial discipline on corporate executives and government leaders as we do on the middle class, then we would have a real answer to the retirement problems.